Section 2 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Conclusions of the Financial Crisis Inquiry Commission, Part 2. This report describes the events and the system that propelled our nation toward crisis. The complex machinery of our financial markets has many essential gears, some of which played a critical role as the crisis developed and deepened. Here, we render our conclusions about specific components of the system that we believe contributed significantly to the financial meltdown. We conclude collapsing mortgage lending standards and the mortgage securitization pipeline lit and spread the flame of contagion and crisis. When housing prices fell and mortgage borrowers defaulted, the lights began to dim on Wall Street. This report catalogs the corrosion of mortgage lending standards and the securitization pipeline that transported toxic mortgages from neighborhoods across America to investors around the globe. Many mortgage lenders set the bar so low that lenders simply took eager borrowers' qualifications on faith, often with a willful disregard for a borrower's ability to pay. Nearly 1/4 of all mortgages made in the first half of 2005 were interest-only loans. During the same year, 68% of option ARM loans originated by Countrywide and Washington Mutual had low or no documentation requirements. These trends were not secret. As irresponsible lending, including predatory and fraudulent practices, became more prevalent, the Federal Reserve and other regulators and authorities heard warnings from many quarters. Yet the Federal Reserve neglected its mission, quote, to ensure the safety and soundness of the nation's banking and financial system and to protect the credit rights of consumers, unquote. It failed to build the retaining wall before it was too late, and the Office of the Comptroller of the Currency and the Office of Thrift Supervision, caught up in turf wars, preempted state regulators from reining in abuses. While many of these mortgages were kept on banks' books, the bigger money came from global investors who clamored to put their cash into newly created mortgage-related securities. It appeared to financial institutions, investors, and regulators alike that risk had been conquered. The investors held highly rated securities they thought were sure to perform. The banks thought they had taken the riskiest loans off their books, and regulators saw firms making profits and borrowing costs reduced. But each step in the mortgage securitization pipeline depended on the next step to keep demand going. From the speculators who flipped houses, to the mortgage brokers who scouted the loans, to the lenders who issued the mortgages, to the financial firms that created the mortgage-backed securities, collateralized debt obligations, or CDOs, CDOs squared, and synthetic CDOs. No one in this pipeline of toxic mortgages had enough skin in the game. They all believed they could offload their risks on a moment's notice to the next person in line. They were wrong. When borrowers stopped making mortgage payments, the losses, amplified by derivatives, rushed through the pipeline. As it turned out, these losses were concentrated in a set of systemically important financial institutions. In the end, the system that created millions of mortgages so efficiently has proven to be difficult to unwind. Its complexity has erected barriers to modifying mortgages so families can stay in their homes, and has created further uncertainty about the health of the housing market and financial institutions. We conclude over-the-counter derivatives contributed significantly to this crisis. The enactment of legislation in 2000 to ban the regulation by both the federal and state governments of over-the-counter or OTC derivatives was a key turning point in the march toward the financial crisis. From financial firms to corporations, to farmers, and to investors, derivatives have been used to hedge against or speculate on changes in prices, rates, or indices, or even on events such as the potential defaults on debts. Yet, without any oversight, OTC derivatives rapidly spiraled out of control and out of sight, growing to $673 trillion in notional amount. This report explains the uncontrolled leverage, lack of transparency, capital and collateral requirements, speculation, interconnections among firms, and concentrations of risk in this market. Over-the-counter derivatives contributed to the crisis in three significant ways. First, one type of derivative, credit default swaps, or CDS, fueled the mortgage securitization pipeline. Credit default swaps were sold to investors to protect against the default or decline in value of mortgage-related securities backed by risky loans. Companies sold protection, to the tune of $79 billion in AIG's case, to investors in these newfangled mortgage securities, helping to launch and expand the market and, in turn, to further fuel the housing bubble. Second, credit default swaps were essential to the creation of synthetic collateralized debt obligations. These synthetic collateralized debt obligations were merely bets on the performance of real mortgage-related securities. They amplified the losses from the collapse of the housing bubble by allowing multiple bets on the same securities and helped spread them throughout the financial system. Goldman Sachs alone packaged and sold $73 billion in synthetic collateralized debt obligations from July 1, 2004 to May 31, 2007. Synthetic collateralized debt obligations created by Goldman referenced more than 3,400 mortgage securities, and 610 of them were referenced at least twice. This is apart from how many times these securities may have been referenced in synthetic collateralized debt obligations created by other firms. Finally, when the housing bubble popped and crisis followed, derivatives were in the center of the storm. AIG, which had not been required to put aside capital reserves as a cushion for the protection it was selling, was bailed out when it could not meet its obligations. The government ultimately committed more than $180 billion because of concerns that AIG's collapse would trigger cascading losses throughout the global financial system. In addition, the existence of millions of derivatives contracts of all types between systemically important financial institutions, unseen and unknown in this unregulated market, added to uncertainty and escalated panic, helping to precipitate government assistance to those institutions. We conclude the failures of credit rating agencies were essential cogs in the wheel of financial destruction. The three credit rating agencies were key enablers of the financial meltdown. The mortgage-related securities at the heart of the crisis could not have been marketed and sold without their seal of approval. Investors relied on them, often blindly. In some cases, they were obligated to use them, or regulatory capital standards were hinged on them. This crisis could not have happened without the rating agencies. Their ratings helped the market soar, and their downgrades throughout 2007 and 2008 wreaked havoc across markets and firms. In our report, you will read about the breakdowns at Moody's, examined by the Commission as a case study. From 2000 to 2007, Moody's rated nearly 45,000 mortgage-related securities as AAA. This compares with 6 private sector companies in the United States that carried this coveted rating in early 2010. In 2006 alone, Moody's put its AAA stamp of approval on 30 mortgage-related securities every working day. The results were disastrous. 83% of the mortgage securities rated AAA that year ultimately were downgraded. You will also read about the forces at work behind the breakdowns at Moody's, including the flawed computer models, the pressure from financial firms that paid for the ratings, the relentless drive for market share, the lack of resources to do the job despite record profits, and the absence of meaningful public oversight. And you will see that without the active participation of the rating agencies, the market for mortgage-related securities could not have been what it became. There are many competing views as to the causes of this crisis. In this regard, the Commission has endeavored to address key questions posed to us. Here, we discuss 3: capital availability and excess liquidity, the role of Fannie Mae and Freddie Mac, the GSEs, and government housing policy. First, as to the matter of excess liquidity. In our report, we outline monetary policies and capital flows during the years leading up to the crisis. Low interest rates, widely available capital, and international investors seeking to put their money in real estate assets in the United States were prerequisites for the creation of a credit bubble. Those conditions created increased risks, which should have been recognized by market participants, policymakers, and regulators. However, it is the Commission's conclusion that excess liquidity did not need to cause a crisis. It was the failures outlined above, including the failure to effectively rein in excesses in the mortgage and financial markets, that were the principal causes of this crisis. Indeed, the availability of well-priced capital, both foreign and domestic, is an opportunity for economic expansion and growth if encouraged to flow in productive directions. Second, we examined the role of the GSEs, with Fannie Mae serving as the Commission's case study in this area. These government-sponsored enterprises had a deeply flawed business model as publicly traded corporations with the implicit backing of and subsidies from the federal government and with a public mission. Their $5 trillion mortgage exposure and market position were significant. In 2005 and 2006, they decided to ramp up their purchase and guarantee of risky mortgages, just as the housing market was peaking. They used their political power for decades to ward off effective regulation and oversight, spending $164 million on lobbying from 1999 to 2008. They suffered from many of the same failures of corporate governance and risk management as the Commission discovered in other financial firms. Through the third quarter of 2010, the Treasury Department had provided $151 billion in financial support to keep them afloat. We conclude that these 2 entities contributed to the crisis, but were not a primary cause. Importantly, GSE mortgage securities essentially maintained their value throughout the crisis and did not contribute to the significant financial firm losses that were central to the financial crisis. The GSEs participated in the expansion of subprime and other risky mortgages, but they followed rather than led Wall Street and other lenders in the rush for fool's gold. They purchased the highest rated non-GSE mortgage-backed securities, and their participation in this market added helium to the housing balloon. But their purchases never represented a majority of the market. Those purchases represented 10.5% of non-GSE subprime mortgage-backed securities in 2001, with the share rising to 40% in 2004 and falling back to 28% in 2008. They relaxed their underwriting standards to purchase or guarantee riskier loans and related securities in order to meet stock market analysts' and investors' expectations for growth, to regain market share, and to ensure generous compensation for their executives and employees, justifying their activities on the broad and sustained public policy support for home ownership. The Commission also probed the performance of the loans purchased or guaranteed by Fannie and Freddie. While they generated substantial losses, delinquency rates for GSE loans were substantially lower than loans securitized by other financial firms. For example, data compiled by the Commission for a subset of borrowers with similar credit scores, scores below 660, show that by the end of 2008, GSE mortgages were far less likely to be seriously delinquent than were non-GSE securitized mortgages, 6.2% versus 28.3%. We also studied at length how the Department of Housing and Urban Development, or HUD's, affordable housing goals for the GSEs affected their investment in risky mortgages. Based on the evidence and interviews with dozens of individuals involved in this subject area, we determined these goals only contributed marginally to Fannie's and Freddie's participation in those mortgages. Finally, as to the matter of whether government housing policies were a primary cause of the crisis, for decades, government policy has encouraged homeownership through a set of incentives, assistance programs, and mandates. These policies were put in place and promoted by several administrations and Congresses. Indeed, both Presidents Bill Clinton and George W. Bush set aggressive goals to increase home ownership. In conducting our inquiry, we took a careful look at HUD's affordable housing goals, as noted above, and the Community Reinvestment Act, or CRA. The Community Reinvestment Act was enacted in 1977 to combat redlining by banks, the practice of denying credit to individuals and businesses in certain neighborhoods without regard to their credit worthiness. The Community Reinvestment Act requires banks and savings and loans to lend, invest, and provide services to the communities from which they take deposits, consistent with bank safety and soundness. The Commission concludes the Community Reinvestment Act was not a significant factor in subprime lending or the crisis. Many subprime lenders were not subject to the Community Reinvestment Act. Research indicates only 6% of high-cost loans, a proxy for subprime loans, had any connection to the law. Loans made by CRA-regulated lenders in the neighborhoods in which they were required to lend were half as likely to default as similar loans made in the same neighborhoods by independent mortgage originators not subject to the law. Nonetheless, we make the following observation about government housing policies. They failed in this respect. As a nation, we set aggressive homeownership goals with the desire to extend credit to families previously denied access to the financial markets. Yet the government failed to ensure that the philosophy of opportunity was being matched by the practical realities on the ground. Witness again the failure of the Federal Reserve and other regulators to rein in irresponsible lending. Homeownership peaked in the spring of 2004 and then began to decline. From that point on, the talk of opportunity was tragically at odds with the reality of a financial disaster in the making. When this commission began its work 18 months ago, some imagined that the events of 2008 and their consequences would be well behind us by the time we issued this report. Yet more than 2 years after the federal government intervened in an unprecedented manner in our financial markets, our country finds itself still grappling with the after effects of the calamity. Our financial system is, in many respects, still unchanged from what existed on the eve of the crisis. Indeed, in the wake of the crisis, the U.S. financial sector is now more concentrated than ever in the hands of a few large, systemically significant institutions. While we have not been charged with making policy recommendations, the very purpose of our report has been to take stock of what happened so we can plot a new course. In our inquiry, we found dramatic breakdowns of corporate governance, profound lapses in regulatory oversight, and near fatal flaws in our financial system. We also found that a series of choices and actions led us toward a catastrophe for which we were ill prepared. These are serious matters that must be addressed and resolved to restore faith in our financial markets, to avoid the next crisis, and to rebuild a system of capital that provides the foundation for a new era of broadly shared prosperity. The greatest tragedy would be to accept the refrain that no one could have seen this coming, and thus nothing could have been done. If we accept this notion, it will happen again. This report should not be viewed as the end of the nation's examination of this crisis. There is still much to learn, much to investigate, and much to fix. This is our collective responsibility. It falls to us to make different choices if we want different results. End of section 2 and of the conclusions of the report.